Hey guys, Mike here. So about once a month, usually Cathie Wood, Ark Invest, and her team come out with data they compiled about inflation, where they see it going, monetary, physical policy, stuff like that, and how it's affecting the market overall. And it's very rare that you see any fund manager, for that possibility, come out and actually say they're confused. Like, actually admit it. I mean, that's something you just don't see. And I appreciate it when they do it. Every once in a while you get one that says that. And that's what she's going to say in this video today. You know, I take the 45 minutes for you guys as usual, compact it down in as short amount of time as possible to give you the highlights and stuff. The rest of the stuff you've heard a million times over. And so, you know, hopefully you get something out of this. And she does make, really, I don't say points. I mean, she puts the data out there. But I'll kind of give you what I think, because it really coincides with a lot of the videos I've been putting out lately. And the one thing I want you to take away from this is, remember, if you didn't see Friday's video, I'll link it at the end. We are in a scientific experiment right now. Nobody knows where this is going, because there's never been a time with this kind of macro data and all these different indicators coming out that don't add up. Okay, and I'm gonna touch base on that more as we go. But, you know, this is the first thing she touches base on, is it pretty much what I've been saying too, that some of this stuff just isn't really adding up.
Now, the consumption indicators that have come out over the last month are quite confusing. If you look at the macro numbers that came out, personal consumption expenditures for April came out at 0.9%. That's nominal, so that includes inflation. Excluding inflation, 0.7%. So that was a pretty strong report after a great degree of sluggishness. The reason it's surprising is we also got the University of Michigan's Consumer Sentiment Index, and it fell. It fell to a new low, and we're back to where we were in 08, 09. So that is not a good place, and it's hard to understand why consumers would be spending so much. The other confusing statistic to me is consumer credit, the change in consumer credit outstanding. Now, this includes both revolving, so credit cards, and installment debt. And these are huge numbers for March and April, 37 billion and 52 billion. Normally, we're used to seeing 6 billion or 5 billion. Now, I have seen this before at turning points in the cycle when consumers or small businesses, probably more the latter, but applying as consumers, they are worried about their ability to get credit in the future. So they take down their credit lines. And we're wondering if that's part of what's going on right now. The other puzzle here is the consumer saving rate, which peaked at, I believe, 34% in April or May of 2020. Dropped and has been revised down and has dropped to 4.4%. So pre-COVID, we were at 8%. We're down to 4.4%. And we haven't seen that level since 08, right around the time Lehman went bankrupt. So it's confusing. The combination of sentiment and savings, low savings, very low sentiment, the consumer would not seem to be in a spending mood.
And don't forget to hit that like and subscribe button, guys, if you get something out of this. And so hopefully that makes sense. I mean, you got consumer sentiment as bad as it was in 08. And think about 08. The financial crisis, we thought the whole banking system was coming down. We'd never seen the real estate market crash and burn like that. People getting evicted and foreclosed on at record rates we'd never seen before, okay? We got none of that going on right now, yet we got the same sentiment. And why? Simple. Inflation, costs, right? Every time you go to fill your car up at the gas station, it goes higher and higher, right? Every time people try to apply to buy a house, the mortgage rates are through the roof, the prices are through the roof. Somebody tries to go renew their lease, the rents are up between 10-20%, right? And I can go on, but that's why. I mean, it's like my brother just told me yesterday. He says, he's been a cop for 18 years. He used to go to the same place before 2020 and everything shut down to buy a chicken salad. I mean, it was the same thing. He ordered every day, $8.50 for years, right? Between $8 and $8.50. And just went back for the first time, I think it was Friday, and ended up the same exact salad, $19. $19. He was like, what? It's a salad. It's got some leaves, one piece of chicken. I mean, that's from $8.50 to $19. And they said, we're sorry, you know. I'm like, yeah, we hear that everywhere. And so that's why the consumer sentiment's down. So you would think, usually consumer sentiment's down, people aren't spending, but people are still spending. And that's where, you know, the overall, this 2.3 trillion we keep hearing about. If you didn't watch my little Kool-Aid or Punch Bowl video, I'll put that at the end as well. That's where all that money's still sitting at. We just don't know, and I still can't find out, you know, per like bracket of income, how much of that is actually in savings. And the reason, of course, the savings rate's down is because the costs are going through the roof. That's why it's hard to save, right? When you're actually having to save as much, when all of a sudden now inflation is doing this over and over and over, month over month over month, right? And so some of the stuff just don't add up. And as far as the credit cards, yeah, people are applying for, I told you that, applying for millions of credit cards. I know people that are taking HELOCs out on their house just in case, right? Because why not? I mean, they just want to have it just in case. They don't know what's going to happen. So, you know, that's what they're doing. So that doesn't surprise me at all. But, you know, it's just interesting to hear any fund manager say, especially from her, since she used to be an economist, that it's kind of confusing. Like things just aren't really adding up. And that's why I told you in Friday's video that this is a scientific experiment. Never been done before with this many things going on at one time. Okay? It's usually a couple over here, but not all of this being put and happening at the same time. And that's why nobody can figure out what's going to happen. Just the way it is. Okay? We know, just kind of speculate. So, you know, the next thing she goes over, which I find to be interesting, is inventories. And this is going to be interesting to see how this plays out when it comes to costs.
We are seeing inventory increases, the likes of which I have never seen in my career. And I'm talking about on a company by company basis. So Walmart sales up 3% on a comparable store basis year over year, which means they were probably down in unit terms. Inventory is up 33%, which probably means in real terms, taking away inflation, they were up 25 to 30%. Well, that's interesting because more than half of Walmart's sales are in groceries. And you're not going to see huge inventory buildups in groceries. And so what does this say for the other half? Are their inventories up 80%? You know, it's kind of crazy to think that that's a possibility, but it's a possibility. And Target's inventories were up 42%. Now it has less in the way of groceries as a share of the total. So 42%, maybe if you X groceries, was up 50 to 60%. These are crazy numbers for two of the best managed companies from a supply chain management point of view in the world. And so maybe a Jamie Dimon is starting to see this backing up in other ways, in terms of the way the information he has.
And I find this one to be probably the most interesting because, you know, these are two, you know, of the most well-run companies out there. No matter what you think about them, they didn't get to be where they're at because, you know, they're poorly managed. Okay, they're two of the conglomerates out there as far as brick and mortar retail. And especially Target's been coming on like a freight train over the last 5 years. And to see those kind of inventory levels, I mean, I don't know if you saw it, but I talked about the CEO of Target going on TV after earnings, and he talked about it. They really mismanaged it. I mean, they couldn't see this coming. Again, they just couldn't see it coming. The supply chain issues were so bad, and now all of a sudden they got all this inventory that they don't need because the consumer actually switched on what they're buying. So now they're kind of stuck. So the good thing is, hey, if you're looking for some deals, I have a sneaking suspicion Target's going to have some pretty good deals on certain items because they need to get rid of it. What happens when you need to get rid of something because you got so much inventory? You can lower the prices. You know, so that's going to be interesting to see how it affects it. But again, it can't be in groceries, right? I mean, that's perishable stuff. So probably not there. So, you know, that's just how is that going to have any effect on inflation? What's it going to do? And so we're going to see on that one. And the last one she goes on to talk about is one I've been talking about a lot, which is oil, gas, and utilities, which is absolutely just decimating the average day person out there.
You're seeing in the sectors, as equities are broken out by something called GICS sectors, energy they tend to do well in inflationary times. If we're right and fiscal and monetary policy are both very tight and getting tighter, then at some point this is going to flip. We will flip away from this value rotation and back to growth. And it couldn't happen too soon for us, of course. On the losing side, consumer discretionary, and of course any advertising sensitive company is getting hit here, especially on the social side, and especially with the competition from TikTok. So it's hard to tell how much of this is a competitive dynamic and how much of it is an economic dynamic. It's probably both.
And of course she's right, because I mean, these are cyclical, right? I mean, I've said that, but the problem is when. That's the question. When's it going to happen? And if you are on the right side of that trade when these start to tank, because they're going to tank like tech stocks did starting in November, it's going to be fast. I'll tell you right now. You're going to make a lot of money. And as far as the inflation, I mean, look, I don't remember high inflation from 2011, 2014, but oil skyrocketed, right? And so, I don't think that has as much to do with it as infrastructure, manipulation, politics. I mean, they don't call OPEC a cartel for no reason, okay? And so, that's just is what it is. And so we have to deal with that. Eventually, though, it will flip, and that money will go somewhere. And so, the other one is, I just want to throw that in about the ad revenue. I can tell you firsthand, being here on YouTube, that has dropped off a cliff. You don't see as much, even from other YouTubers. You don't see much affiliate, like them getting paid to put, sponsorship in the videos and stuff like that. You don't see that anywhere near as much right now. I mean, that has been cut. And of course, competition. No doubt TikTok is taking shares from Twitter and other companies and stuff like that. But, it's just one of those things. If you're in those stocks, when they report earnings, I can imagine it's going to be great. And so, we'll see how Google does, because that's where they get a lot of their money from. So I just want to bring that to you, shorten it down from 46 minutes to whatever this video ends up being for you. So hopefully you got something out of that and stuff. Hit the like, subscribe button if you did. Really appreciate that, guys. And I'll see you guys tomorrow.